So we are doing the chapter futures, in which we completed up to question number 3, that is mark to market procedure we completed. That is question number 4, mark to market procedure problem we completed. Today we will be doing the following areas. How the margin account looks like the concepts like variation margin, initial margin and maintenance margin. Very simple issue. Number 2, what is open interest? How to calculate, how the open interest is calculated is the second issue. Then third, we will discuss about fair futures price. What should be the theoretical futures price? The valuation of futures we will be discussing. Both stock futures and then index future we will discussing about the fair futures price. And if the actual future price is different than the fair futures price, how to make an arbitrage out of it. All these issues we will try to complete in today's class. 2 more classes will complete this chapter, futures. Next class will be discussing about commodity futures and concept of backwardation and contango. Then next class, commodity futures, arbitrage, no arbitrage boundaries, all this will be discussing in the next class. 1 more class I will complete the chapter by doing the futures hedging through futures, where we see the straight hedging as well as the beta hedging using the futures contract. And 2 more classes will complete the futures. Then we'll do 1 class for the currency futures. We just left out in the application of derivatives. Once we complete that, we move on to the interest rates area, like interest rate risk management, where we'll discuss forward rate agreement, then interest rate futures, interest rate guarantee, interest rate swaps, interest rate options. All this will be discussing in the next slot. Okay. Once these are all over, derivative is said to have been completed. Then we have only some easily doable chapters. Not so much detailed explanation is required, like a equity valuation or a mergers and a mutual fund. Each will not take more than 2 classes to complete. Okay. It is not a difficult area, but our main difficulty part gets completed as soon as we complete the derivative segment, that is in the interest rate swaps and currency swaps. The derivative gets completed. Please. Now let us summarize what has been discussed before I proceed further. For example, TCS shares can be quoted in 2 markets. Or 2 markets? Cash market and then futures market. The price quoted in cash market is the spot price. Price quoted in the future market is the forward price. So, cash market price is the price at which I can buy or sell TCS share today. Futures market always will have an expiration date for that contract. Suppose they say March TCS futures expiring on 27th March is trading at 2,200 rupees, some example. Okay, that means person is going to buy the TCS futures has agreed to buy the TCS shares on 27th March at the futures price that is traded today. Similarly, person who is agreed to sell has agreed to sell the TCS shares at that price on 27th March. So person who is going to buy futures is called as long futures position, and sell futures is said to be taking short futures position. We cannot enter into a future for a share, we have to enter into for a contract. A contract size will be standardized. For example, TCS shares has a 250 shares as a contract price, and Nifty may have 100 say Nifty as a contract price and so on. So the exchange determines the contract size. The around 2 lakhs to 3 lakhs they wanted to fix as a value for a futures contract. Based on the average price traded of the particular share, they fix the contract price. Next, on maturity date, most of the futures contract will not be settled through delivery. They are going to be settled through a cash settlement process. In cash settlement, if we have a futures buy, the exchange gives you a counter future sell. If we have a future sell, exchange gives you a counter future buy. So the difference is the profit or loss which they book. For the exchange, it is going to be a counterparty for two parties. For a buyer, it is a counterparty as a seller. For a seller, it is a counterparty as a buyer. And it will be transferring the money from one person's account to another person's account based on who is making profit and who is incurring loss. And this is done through the clearing house of the exchange. Next is, here we saw that since the exchange is the counterparty, not the other person, always the exchange is exposed to a counterparty risk. Person who is suffering losses should not run away without giving the money. So exchange says deposit some initial margin and then start the futures contract. The initial margin percentage is fixed on the contract value. The percentage is not same for all the shares. Some shares may have an initial margin of 5%, some may have an initial margin of 10% and so on. The percentage depends on the volatility of the share prices. If a price of a share is highly volatile, then the exchange is having a lot of counterparty risk. Then it will be asking for a bigger margin. Share is less volatile, it will be asking for a smaller margin. What should be the margin percentage fixed? Depends on the concept called as VAR. VAR means value at risk. And that is done through a software called as SPAN throughout the world, called as Standard Portfolio Analysis. Then since we saw that futures need not be settled by delivery, in cash market what is deliverable only can be bought and sold. You cannot buy and sell a Nifty in the cash market, because if I buy a Nifty, I don't buy any share, I only buy an index points. Points cannot be delivered. But in futures market, Nifty can be traded or not? Yes. How the Nifty can be traded? Because we don't need to have a delivery. If you go for a buy Nifty, then we're giving a counter sell Nifty at that futures price, and the difference will be booked as profit or loss, is what we had discussed. So there is something called as index futures, which is very helpful in lot of hedging strategies. We'll see the index hedging in the second succeeding class, how it should be done. Everybody following or not? Now, nowadays there's a very famous fund called as index funds also. Above that we'll discuss in the mutual fund chapter later. That is only making us index hedging very much possible. Can I proceed further or not? Now, next is, then we also discussed the concept called as mark to market procedure. Now I buy futures and before that, can we exit before the maturity date? Yes. If we have a buy futures, you can come out any day by giving a counter sell. If you have a sell, you can come out any day by giving a counter buy futures at the futures price prevailing on that particular day. And finally, the exchange does not book profit or loss at the end of a period. The profit or loss is booked on a day-to-day basis. Two reasons: exchange is safeguarded because there will be on the day itself, when the money is available in the margin account, will be booking the profit or loss. And number two is, when a person wants to come out, he'll come out at the current market price. There is no problem in changing over from one margin account to another margin account. So in this particular case, so we maintain something called as mark to market procedure. Daily the future contract is closed at the settlement price fixed by the exchange at the end of the day. Next day it gets open at the previous day's settlement price, and the day beginning price and the settlement price, the difference is going to be the profit or loss transfer from one person's account to another person's account. Everybody following or not? Now, in that case, settlement price generally can be understood to be the last price that is traded in the futures exchange. Last transaction will take place now, that price can be called as a settlement price. But where the exchange feels it can be rigged, etc., normally they fix the settlement price based on the last few minutes transaction, based on VWAP. That means what? Weighted average, weighted volume weighted average price. Based on the price, they fix the settlement price. Examination always will give you the settlement price. You have to only book the profit or loss. Is what has been discussed in the futures till now. Everybody respond. Are you following or not? Now, have you all gone home and revised what has been discussed? No. Because again I say, continuity, I cannot once again begin explaining all this concept again and again. But we discussed very elaborately. I dictated notes also for each and every aspect. It is for you to have revised. Otherwise, you may also feel sometimes difficult to understand what is happening. I hope we have revised and then continue with the discussion. Can I proceed? Now, next. See, we all know that we can enter into the futures market only with the margin. Only with what? Margin. The margin they ask you to deposit is called as initial margin. First we enter with the margin called as what? Initial margin. Why the exchange asks you to deposit margin? So that in the margin account when you deposit the money, when you incur losses in the futures market, what happens? They will be recovering it from your margin account and transfer to the margin account of the other party who had made a gain. Yes or no? And when you have made a gain, your margin account gets augmented. More amount will be deposited in the margin account. So any profit or loss will be deposited or will be withdrawn from the margin account only. And initially they ask you to deposit the margin. That margin is called as what? Initial margin. Point number 1. Respond is or no? See, what happens is, suppose you are continuously suffering losses. You are continuously what? Suffering losses. Will the margin account balance increase or decrease? Margin account balance what? Decrease. Suppose your margin account balance is exhausted. Then will it become negative? Bank overdraft and all, bank gives or not? Will it be negative? It will not be negative. That is, you will be sent out of the market by closing the contract. Your contract will be alive as long as the money is there in what? The margin account. Everybody understood or not? Now, see, in that case, the exchange gives you an intimation to deposit what? Money. When they give intimation is, not that when the balance becomes zero, they don't give intimation. Something similar to reorder level. We have discussed or not? No. When you go for a new purchase order, when the stock becomes zero or no. When the stock is what? At some level, you just go for the purchasing like that. When the balance in margin account touches some number, the exchange gives an intimation saying that your margin account balance is danger. Please immediately what? Deposit the money. Okay. In such case, you should deposit the money to keep your futures account what? Alive. How much you deposit? So much you deposit to make the margin account balance reach back to what? Initial margin. Everybody following? I'll give an example. Suppose initial margin 12,000 rupees. What is initial margin here? 12,000. That means I have to enter into the exchange by depositing how much with the exchange here? 12,000 rupees. Yes or no? No. I am suffering losses. Will it be more than 12,000, less than 12,000? Less than 12,000. They slowly withdraw. Suppose they fix something called as maintenance margin. They fix something called as what? Maintenance margin, 9,000 rupees. The meaning is, when it touches 9,000 rupees, the exchange gives me a call asking me to deposit money in the margin account. Respond is or no? No. That margin at which we have to deposit is called as what margin? Maintenance margin. Suppose it has become 8,000. From 9,000 some crash in stock price happens. It becomes what rupees here? 8,000. Not 9,000. 10,000 becomes what? 8,000. Immediately a call will be received asking me to deposit. How much should I deposit? From 8,000 to 9,000, 8,000 to 12,000, 8,000 to 12,000. I should deposit the money to make it reach back what? The initial margin. Respond is or no? No. The amount which I am depositing is called as variation margin. Called as what margin? Variation margin. Now listening. What is the initial margin? 12,000 rupees. Example, how much rupees here? 12,000 rupees. What maintenance margin? 9,000 rupees. Suppose from 10,000, one share price crashes, okay. See, it drops to what? 8,000. It drops to what? 8,000. Immediately what I should do? Deposit. Why should I deposit? It has breached the maintenance margin. What is maintenance margin? 9,000. When I deposit, should I deposit 8,000 to 9,000, 8,000 to 12,000, 8,000 to 12,000. How much I deposit? 4,000. Now there are three numbers: 12,000, 9,000, 4,000. What is 12,000? Initial margin. What is 9,000? Maintenance margin. What is 4,000? Variation margin. These are the three types of margins in the margin account. Respond yes or no? No. And last one more thing is, when a person, that is how futures contract can be closed. You are having a futures contract now. How many ways your contract can get closed? Tell me. 3 ways. One is when it reaches maturity date, it automatically get closed. When the money is not there in margin account, it automatically get closed. Third is what? When you want to exit and give a counter buy and sell and then come out of it, are the three ways in which the futures contract gets closed. Everybody, are you understanding it or not? Can I proceed further? Now. So now let us do one problem where we'll be discussing the mark to market procedure along with the initial margin, maintenance margin and then variation margin, and then go for the next issue. Can we start or not? Now. Please take question number 5. Take question number 5. What one? Notes for mark to market. I have not given a. Okay, write down. Point number 1. Write down notes. I am giving notes for the question number 4. Mark to market procedure. Okay, notes. Write point number 1. Mr. Ram. Question number 4, point number 1. Mr. Ram, please, Mr. Ram, understand that we are in March. We should complete the portions. Every chapter is important. At this time, show some seriousness. Can I proceed now? See, Mr. Ram buys futures at 1,500. Mr. Ram buys futures at 1,500 and exits after 3 days. Buy futures at 1,500 and exit after 3 days and exit after 3 days by giving a counter sell at how much rupees? 1,600. By giving counter sell at 1,600, thus booking a profit of how much rupees? 100 rupees in his margin account. Thus booking a profit of 100 rupees in his margin account. Thus booking a profit of 100 rupees in his margin account. The first point. Can I proceed? Point number 2. Is the 100 rupees profit credited to his margin account? Is the 100 rupees profit credited to his margin account on the exit date? Is the 100 rupees profit credited to his margin account on the exit date? Credited to his margin account on the exit date. Question mark. Tell me yes or no? No. The answer is what? No. Full stop. The exchange books the profit on futures contract. The exchange books profit or loss on futures contract. The exchange books profit or loss on the futures contract. The exchange books profit or loss on the futures contract on a daily basis. The exchange books profit or loss on the futures contract on a daily basis using what procedure? Mark to market procedure. Using mark to market procedure. On a daily basis using mark to market procedure. Can I proceed? Point number 2 or 3? 3. Every day the exchange closes. Point number 3. Every day the exchange closes all the outstanding futures contracts every day the exchange closes all the outstanding futures contract and transfers the profit between margin accounts through the clearing house, at a price called as what price? Settlement price. At a price called as settlement price. So when I say when the exchange closes the contract, it should be at a price or not? There it should be linked at a price called as what? Settlement price. At the price called as settlement price. Can I proceed? Next point number 3 or 4? 4. Settlement price can be simply understood to be the last traded price. Settlement price can be simply understood to be the last traded price. It is generally the volume weighted average price. Of the transactions taking place. In the last few minutes of the day. Is generally the volume weighted average price of the transactions taking place in the last few minutes of the day. The exchange reserves the right to fix. Any settlement price it wants. The exchange reserves the right to fix any settlement price it wants. You cannot question them, okay, how you calculated, they will be having the right to, that is a general rule. Normally it's how they do it. They will fix the right to fix the any settlement price they want. Can I proceed or not? Next. Point number 3 or 4? Point number 5. When the futures contract are reopened next day, they open at what? Previous day's settlement price. When the futures contract reopens next day, they open at what? Previous day's settlement price. Everybody, are you able to understand or not? That is why I entered into the market. Please tell me, enter the market at how much buy futures? 1500. Now, at the end of the day, what the settlement price fixed by the exchange? 1520. They booked me how much profit? Next day is my futures contract. Futures buy for 1500 or 1520. Now already I have booked what? 20 rupees profit. Anything above 1520 only should be a gain for me. Respond, yes or no? In that case, it becomes what? 1520. Then I have to close of 1490 and so on. It gets opened at what? The previous day's settlement price is the meaning. Everybody, are you following what I am saying? Now, next, give the heading. Types of margin accounts. Give the heading. Types of margin accounts. We'll do the problem and then have the notes with the numbers in hand. Okay, can I proceed? Types of margin accounts. Underline that. Take question number 5. Please take question number 5. On November 15, please, page number 101, taken the problem or not? Now, on November 15, when the spot price for telco was 473 per share. Old problem, yeah. Don't look at the share price today. Okay. Spot price of telco was 473 per share. Mr. X buys 15 contracts of July telco futures at 491. Assume that initial margin for telco futures is 800 per contract and the maintenance margin is 600 per contract. Given each contract is for 50 shares. Daily settlement prices for the next few days are as follows. November 15, 496. Who fixes this 496? Exchange. Generally we understand to be the last price, the closing price of the day they close. For theoretical understanding, practically it need not be the last closing price. It can even be the price fixed by the exchange on an average basis. Okay, exchange fixes. November 16, 503 and so on, given up to November 19. Assume that Mr. X withdraws profit from his margin account only once in November 16 when he withdraws half the maximum amount allowed. Compute the balance in the account at the end of each of these 5 days. Is a question they are asking you to do. Okay, just go through the problem before I start with the solution. Please go through the question quickly. Shall I start up? Now, tell me, when I enter into the futures market, which date? November 15. On the day, they are given two prices. How many prices? Two prices. One is what? Sorry, one is how much here? That is 473. What is 473? Spot price. That means I can buy and sell the telco share today at how much rupees? 473. But another price is also called how much rupees? 491. When it is quoted today, for what transaction? Transaction expire on July end. They give you the July futures. Enna parida not now. So at what price? 491. You took a position in the futures market na. You took a buy position na, sell position na. So buy or sell. Mr. X buys 15 contracts of telco futures at 491. Okay, you took a buy position for how many contracts? 15 contracts. 15 contracts are 15 telco shares are? No. 15 contract means what? Every contract is having 50 shares. So what is the size of the 15 contracts? 750 shares. That means I have taken a buy position on how many shares? 750 shares at an agreed price of 491 per share. That is, I have agreed to buy 750 telco shares at the end of July. I don't know expiry date. At the end of July. At what price? 491 is the meaning of this transaction. Okay. Now, July only I have to what? Book profit and loss. Today just enter into agreement, signed. That's all. Enough or not? No. Because they say you should enter into the market by making what? Some deposit. How much should be margin money? 800. Per share per contract? Per contract. How many contracts? 15 contracts. What is the money I should deposit in exchange? 12,000. This 12,000 we call as what margin? Initial margin. Yes or no? Now. And when I entered, they fixed me the maintenance margin also, intimated me. What is the maintenance margin? 600 into 15 gives you what? 9,000. What is the meaning of that? When the margin account balance touches below 9,000, they intimate me to make a deposit. How much should I deposit? Variation margin. What is variation margin? Initial margin minus balance in the margin account, like a petty cash interest. This is what is the problem all about. Every day they gave you the prices. This person is holding the share, that is contract for how many days? 5 days. ask you to prepare a margin account, how it looks like from November 15, 16, 17, 18 and then what? 19. And one more detail they have given is, in between, when he has money in the margin, can be withdrawn or not? Yes, sir. As long as it does not breach the initial margin, money can be what? Withdrawn. And he withdraw 50% of the available money is what is given in the question. In the parallel following or not? No. Based on this, we have been asked to prepare a margin account. Can we start doing it together or not? Right on. First. Right, question number, let's do it together. Take question number 5. Right, question number 5. Point number 1, please. Point number 1. Number of shares on which Mr. X has taken. Number of shares on which Mr. X has taken. Number of shares on which Mr. X has taken. What position? Long futures position. Number of shares on which Mr. X has taken long futures position is equal to, long futures position is equal to, tell the calculation, 15 contracts into 50 shares. 15 contracts into 50 shares is equal to how much here? 750 shares. 750 shares. Can I proceed? Point number 1 or 2? 2. The contract defined. Let us elaborate the contract meaning. Okay, the contract defined. Put a hyphen and write, Mr. X has agreed to buy. Mr. X has agreed to buy. Please tell me, has agreed to buy how many shares? 750 shares of Telco. Mr. X has agreed to buy 750 shares of Telco in July end. I have not been given the future expiration date. We are around 26th to 31st July. Okay, on July end, Mr. X has agreed to buy 750 shares of Telco in July end at what price? 491. At 491. At 491. Can I proceed? Point number 2 or 3? 3. Initial margin. Initial margin is equal to, point number 3, right? Initial margin is equal to what into what? 15 contracts into 800. 15 contracts into 800. What is the amount? 12,000. 15 contracts into 800, 12,000. Next. Maintenance margin. Same point, right? Maintenance margin. Maintenance margin. 15 contracts into 600. 15 contracts into 600 gives you 9,000 is equal to 9,000. Point number 3 or 4 above? Point number 4. Margin account. Point number 4. Margin account for the next 5 days. Margin account for the next 5 days. 5 or 4 days as the case may be, margin account for the next 5 days. Can I start doing together or not? Now, please open along with me the columns. Okay. First, date. We have a buy. We have a sell. We'll be having profit or loss. And we having opening balance, deposit, withdrawal, closing balance. Opening balance, deposit, withdrawal and then closing balance. Date, buy, sell, profit or loss, opening balance, deposit, withdrawal and then what? Closing balance. Withdrawal, if you want, deposit if you want in bracket write VM. VM means what? Variation margin. Always deposit how much in the margin account? Variation margin. Deposit means variation margin here. Deposit means variation margin here. Now, let us do it together one by one. Can we start or not? Have you all finished opening the columns? Now, first, What the day? When I enter into the market? 15 November? 15/11. I entered market 15/11. I entered with a buy order for how much rupees? 491. I gave a buy order for 491. Number la correcta solupa, don't confuse me. Okay, now tell me, at the end of the November 15, look at the workbook next page. The exchange gave you a settlement price. Now what settlement price? 496. So because the exchange closes every day and then open next day, a buy futures will be closed through what? Sell. Some other counterpart will be closed through a counter, buy and so on. Can I proceed or not? Now, you should tell me how much, that is, don't write, how much profit? 5 rupees. For one share, yes or no? And how many shares there? 750. Always multiply by 750. What's the number? 3,750. This is the profit I made in my first day of futures. I started very auspiciously. I am very happy or not? Yes. So first time we enter futures, our account shows what? Profit. Now, how much I deposited? 12,000. In the initial margin I started with, I already deposited how much? 12,000 when I started the contract. That day end, they gave me how much? 3,750. No more deposit, withdrawal. Tell me what is the amount in the margin account? 15,750. The amount is 15,750. I hope everybody understanding it or not. Now, this is a balance in the margin account at the end of the first day. Right or not? Now, next. Second day. What is the date? 16/11. Okay. Now, the exchange reopens my contract at 490. 496. Because already 5 rupees profit has been what? Booked. Now onwards, if I want to make a profit, I would make only from what? 496 and not from 491. Yes or no? In that case, what the opening price? 496. That day in, the settlement price fixed by the stock exchange is how much? 503. Very happy, very auspicious moment I entered into what? Futures market. Profit after profit. Yes or no? Now tell me, how much profit? Number tell me. First amount sollupa. How much rupees here? 7 rupees. Into how much? 750. Tell me number. 5,250. 5,250. Okay. Now, next. What is the opening balance? 15,750. Now, listen here. 15,750 in hand. Profit credit how much? 5,250. Don't write anything. What's the total? 21,000 rupees I am having. Yes or no? Now, in my margin I am having 21,000 rupees or not? What I do? I withdraw. Okay, I just want to withdraw some money for my personal use. Okay, because margin amount is my account only. I can withdraw the money like how I can withdraw from a bank account. Okay, now I want to withdraw. Can I withdraw entire 21,000? Exchange will become angry. Yes or no? Now we cannot withdraw below what? 12,000. That's the initial margin. Yes or no? Now that means the amount permissible to be withdrawn is 21 minus 12 gives how much? 9,000. How many allowed to withdraw? 9,000. Did I withdraw 9,000? No. I can withdraw only what? 50% of the permissible amount. Enough or not? Now, tell me the amount withdrawn by me. 4,500. And write the working note later. Just write it straight away in the number. How much will be is 4,500. 4,500. Out of 21,000 rupees, 15,750 plus 5,250. What is gone? 4,500. What is the balance in margin account? 16,500. Everybody understood or not? So margin account balance is 16,500. Tell me the third date. 17/11. I open at what? 503. Tell me, good time over. What happened? Crash how much rupees? 488 rupees. So the future price drops to what? 488 rupees. Now, exchange will book me a loss of how much rupees per? Yellow base per? 15 rupees. How many shares? 750 shares. Are you understanding and doing it or not? 750 into 15. Tell me the number. One person? 11,250. Profit or loss? Loss. Opening balance? 16,500. Everybody tell me 16,500 there, 11,250 what? Loss. I'll write here 16,500 and 11,250. What the balance? 5,000? 5,250. This is a balance in margin account. Can I continue with this balance? No. Let's drop below what? 9,000. They ask me to what? Top up. Yes or no? Now, I should make this back to what? 12,000. I should make this back to what? 12,000. Tell me how much we deposited? 6,000. This I call as what? Variation margin. We call as what? Variation margin. What should be deposited back? 6,750. You know, yes or no? No. In accountancy, we have a journal entries for all these transactions. 6,750. Can I proceed? No. Let's put it here. So it is withdrawal deposit. Deposit 6,750. Anything withdrawn? No. Tell me what is the balance? Don't do any calculation. I make it reach what? 12,000. That should be the calculation. Calculation is 12,000. Everybody understood or not? No. Tell me the next date is what? 18/11. What was the opening balance? 488. The contract gets opened at 488. Tell me what is the settlement price? 485 above? No. Tell me profit or loss? Loss. 485. What is the loss here? 3 rupees. In how much here? 750. Is how much loss? 2,250. Now what is the balance? 12,000. 12,000 minus 2,250. 12,000 minus 2,250. What is the number? 9,000? 9,050. Should I deposit any money? No. I should deposit only the, say it reaches what? 9,000 mark. Yes or no? No. In that case, no deposit, no withdrawal. What is the closing balance? 9,750. Number correct about 9,750 is the closing balance. Am I right or not? No. Last day is what? 19/11. What is the opening? 485. Settled at what selling price? 491. How much per contract? 6 rupees. In how many cases shares? 750. What the number? Profit? Yes, 4,500. And what is the opening balance? 9,750. Now tell me, 9,750 plus what? 4,500. What is the number? 14,000. This is how the margin account looks like with the initial margin, variation margin and the maintenance margin. Everybody following or not? No. That's how your futures margin account behaves on day-to-day basis. Everybody following or not? No. Suppose you fail to top up, what they will do? They will just close the futures contract once it is going to reach the 0 level. Are you following what I am saying? No. With this, we have completed this particular question number 5 on margin account in futures contract. Respond. Are you following on? No. Next. Okay. I'll give a notes for the margin account now. Question number 6, I'll give it as homework. It is same as question number 5. But instead of margin account for 5 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days. Okay, unnecessarily, no need to spend time in doing it. I just given it only for purpose of solving a practice. So make it as a homework problem. Question number 6 I given as homework. Everybody, yes or no? No. That means I have to give a small notes for the types of margin account and then go for the next concept called as open interest. Everybody, can we start or not? No. Write down notes. Write down notes. Point number 1. Point number 1. Before that, last class, did I dictate any notes about margin account? Why margin account is maintained? No notes given? Okay, write down. In that case, we'll start from that. Okay, write down. There's 1 point only extra. Write down notes. Point number 1. Point number 1. The stock exchange acts as the counterparty. The stock exchange acts as the counterparty for every futures transaction. The stock exchange acts as counterparty for every futures transaction. The stock exchange acts as counterparty for every futures transaction. Can I proceed? Write down. For example, X has given futures by, for example, X has given a futures by and Y a futures sell. X has given a futures buy and Y futures sell. The exchange acts as counterparty to both. The exchange acts as counterparty to both. The exchange acts as counterparty to both. It is seller for X. It is seller for X and what? Buyer for Y. It is seller for X and buyer for Y. Can I proceed? Point number 1 or 2? 2. Suppose X books profit. Suppose X books profit and Y incurs loss. Suppose X books profit and Y incurs loss in the transaction. Suppose X books profit and Y incurs loss in the transaction. The exchange collects the amount from Y. The exchange collects the amount from Y and gives it to what? X. The exchange collects the amount from Y and gives it to X. Continue. Suppose the party Y defaults. Suppose the party Y defaults. He doesn't pay the money. Okay, party Y defaults. Then the exchange is at the risk. Then the exchange is at the risk. Then the exchange is at the risk. Full stop. Everybody yes or no? Now. Point number 2 or 3? 3. To avoid counterparty risk, the stock exchange asks every party to deposit. The stock exchange asks every party to deposit a margin and then start trading. It asks every party to deposit a margin and then start trading with the margin account balance. And then start trading with the margin account balance. And then start trading with the margin account balance. Are you following what I am saying? Now, next point number 3 or 4? 4. How much margin should be deposited? How much margin should be deposited depends on. How much margin should be deposited depends on what? The volatility of the stock prices. Depends on the volatility of the stock prices. Depends on the volatility of the stock prices. Higher the volatility, higher the margin balance. Higher the volatility, higher the margin balance. Higher the volatility, higher the margin balance. They have some formula, 3 sigmas from this number, that number, etc. Higher the volatility, higher. I will just discuss that if you have time later. Okay, higher the volatility, higher the margin balance. Full stop. This is determined using. Continue. This is determined using the concept called. This is determined using the concept called VAR. This is determined using the concept called VAR. Bracket VAR means what? Value at risk. the concept called VAR. In bracket write value at risk, bracket close. And the software used to determine the margin balance, the software used to determine the margin balance is, and the software used to determine the margin balance is what? SPAN. Capital letters SPAN. The software used to determine the margin balance is SPAN. SPAN. Bracket la standard portfolio analysis. S stands for standard. P for what? Portfolio. AN means for what? Analysis. Standard portfolio analysis. SPAN. Bracket right. Standard portfolio analysis. Bracket close. Everybody, are you following or not? Now, next point number 5. There are 3 types of margins. There are 3 types of margins. There are 3 types of margins. Branch it into 3. There are 3 types of margins. Branch it into 3. First branch, initial margin. Second branch, maintenance margin. Third branch, variation margin. Initial margin, maintenance margin, and then variation margin. Initial margin, put the down and write. The margin to be deposited. The margin to be deposited at the inception of contract. The margin to be deposited at the inception of contract. The margin to be deposited at the inception of contract. At the inception of contract. Are you following or not? Now, continue. In this problem, it is, continue. In this problem, it is how much rupees? 12,000. Sometimes it is better to understand through numbers rather than what? The words. In this one, it is how much? 12,000. Next. Maintenance margin. Put it down and write. The margin account balance level at which the margin account balance level at which we should deposit variation margin. The margin account balance level at which we should deposit variation margin. So when it crosses 9,000, deposit variation margin or not? So margin account balance level at which we should deposit variation margin. At which we deposit variation margin. Again put out and write. In this problem it is how much? 9,000. In this problem it is 9,000. In this one it is 9,000. Go to the third branch. What is the third branch here? Variation margin. When the margin account balance goes below maintenance margin, when the margin account balance goes below maintenance margin, when the margin account balance goes below maintenance margin, what should I do? We should deposit. When the margin account balance goes below maintenance margin, we should deposit, fill in the blanks, variation margin. When the margin account balance goes below maintenance margin, we should deposit variation margin. Again put the down and write. Variation margin is equal to formula. Variation margin is equal to what? Initial margin minus. Variation margin is equal to initial margin minus what? Balance in margin account. Okay. Don't say maintenance margin because it may cross 9,000, but it may stop at 8,000. Possible or not? So it is initial margin minus balance in margin account. Initial margin minus balance in margin account. Everybody, are you following or not? Now, next point number 6. Point number 6. Some working notes in the above sum. Just to understand how you calculated now. Point number 6. Some working notes in the above sum. Some working notes in the above sum. Some working note in the above sum. Okay, in that right? Working note number 1. Right, working note number 1. Withdrawal on 16/11. Working out number 1. Withdrawal on 16/11. Withdrawal on 16/11. Underline that. Can I proceed above? Now, opening balance 15,750. Opening balance 15,750. Then, what should I add? Profit. What is the profit that should be added? Tell me the number, please. What is the profit amount? 5,250. What is the total? 21,000. Minus what? Initial margin. Total 21 minus initial margin. Tell me the initial margin amount. 12,000. Available for withdrawal. How much available for withdrawal? 9,000. Withdrawn. That is 50% of 9,000. Is how much rupees? 4,500. Withdrawn 50% of 9,000, 4,500. Withdrawn 4,500. Everybody, are you understanding it or not? No. That's how. One more working note. Working note number 2. Working note number 2. Can you guess what is working note number 2? Variation margin on 17th November. Date correct above? Variation margin on 17th November. Variation margin on 17th November. Can we start up? No. Right? Opening balance. What opening balance on 17th November? 16,500. Opening balance 16,500. Loss. What the loss on the day? 11,250. Loss 11,250. What is the balance here? 5,250. Balance 5,250. Leave one line and write how much should be the initial margin I should be having? 12,000. I should be having 12,000. Balancing, what is variation margin? 6,750. Variation margin 6,750. Variation margin 6,750. Since it has breached 9,000 barrier, I have deposit 6,750 to make it as 12,000. 6,750. Everybody understood or not? No. With this, we have completed this particular concept called as what? Margin accounts and its types. Everybody following on? No. So, what we are now learning is the various aspects of the futures market. Okay. We have not gone into technical issues like what should be the futures price, hedging, arbitrage, all this I did not enter into. We have now been understanding how the futures market works. One of the exam problem, they ask you to prepare this margin account. Everybody, are you following what I am saying? That's why we are doing it not unnecessarily. Everybody following what I am saying? Now, with this, we have completed up to this. Now, can we just give the heading? Concept of open interest. Give the heading, concept of open interest. Give the heading, concept of open interest. Please stop talking. Concept of open interest. O-P-E-N, open, I-N-T-R-E-S-T. Somebody asked now, that's why I am saying, okay, concept of open interest. In the stock exchange codes and all, they use abbreviation OI. OI means what? Open interest. Generally they use mostly abbreviation VWAP means what? Volume weighted average price. Already we discussed in one of the previous discussion like that. So say OI means what? Open interest. That's how they normally quote it. Can we start or not? Now, please. It's a very interesting concept. One should be understanding or one should be aware of, which is very different from the stock market. Very different from what? Stock market, which makes you understand how big is the futures market compared to all the other markets. Okay, if you see all over the world, the most vibrant market is what? The futures market. It is much more bigger than the stock market in terms of the volumes. Okay, now, can you start or not? Now, What do you mean by open interest or open interest contracts is the issue. For that, let us understand how the share market works and then how the future market works to understand the open interest transaction. This is known to you only how the share market works. Still for continuity, I'll just have a discussion and then go for the open interest. Can I proceed now? See. For example, there is a company A Limited. There's a company A Limited. Whose shares are now traded in stock exchange? Is traded in what? Stock exchange. Share is like a commodity. Share is like what? A commodity. You can understand. It's a financial instrument that all them can understand it. Just for simplicity, understand as what? A commodity. So A Limited, 10 lakh shares is now trading in the stock market. How much trading in the stock market? 10 lakh shares is trading in the stock market. This is what they call as market float. They call as what? Market float. That is, the company need not have 10 lakh shares. It may be a company with a 15 lakh share capital also. Are you following what I am saying? But, you have a company with 15 lakh share cap, 15 lakh shares also, but 5 lakh shares may be held by promoters, promoter group, closely held circles, venture capital funds may be holding it. What is available for public buying and selling may be how many shares here? 10 lakh shares. That they normally call as a market float or a free float market. Let's say a free market float. Everybody follow what I am saying? So now 10 lakh shares of this company A Limited shares are trading in the share market. Yes or no? No. Let us first understand how this 10 lakh shares comes into what? Share market for trading. Can I proceed? Now, first of all, the company will go for an IPO. It's the first step. So they go for what? IPO. IPO means what? Initial public offer. First time they go through what? A public issue in the through the stock exchange. They go for what? IPO. So, in that IPO, they issue how many shares here? 10 lakh shares. They issue what? This is how the shares are bought. The shares are first bought in what? IPO only. They issue 10 lakh shares to the public. Okay. So, we all subscribe to the company shares. In this case, is a contract between the company and the public. Yes or no? Company in each and every share is a contract. It's a contract note only. It's a contract between what? The company and then what? Every investor. So how many contracts are created? 10 lakh contracts are created. Yes or no? The 10 lakh shares are what? Issued. The company has created what? 10 lakh contract. In which one of the party is what? The company. Other is you. Everybody. Are you following what I am saying? Okay. Once the shares are issued, they go to what? Stock exchange for listing it. They go for stock exchange for what? Listing the given shares. Okay. Because unless shares are issued, it cannot be what? Listed. They go for the listing. Then the shares will be what? Listed. And they'll be having a code number for each and every share that is being traded. Everybody follow what I am saying? So, now, once the shares are listed in stock exchange, then they can be begin to be traded. Everybody, yes or no? No. So, this IPO, we call as what market? Primary market. Because what market? Primary market. Where one of the party is the company, other party is what? Investor. Through the primary market only, contracts are created. What is created here? Contracts are created where the new shares, 10 lakh shares are bought and then they are listed in what? The stock exchange. From then onwards, that arises what? A secondary market for the share. No. Very simple. Out of the 10 lakh shares, you are one of them. You are what? One of them. Okay. Now, after 10 days, you don't want to have the share, okay. But I want to buy the share. Can I possible or not? No. Is it possible or not? Yes. We do it in what market? Secondary market. So there's going to be a secondary market in which the 10 lakh shares are what? Traded. Now tell me, in the secondary market, I buy the share, you want? Sell the share. Is new shares created? Existing shares traded? There's no new contract created. Existing contract only changes hand from one person to another. Yes or no? Changes hand from what? One person to another. That means I can say the open interest for this company share, how many shares here? 10 lakh shares. That is 10 lakh shares is the open interest. So people can want to trade in this 10 lakh shares by buying or what? Selling. It changes hands, but the open interest is not increase or what? Decrease. Everybody, yes or no? No. This A Limited open interest can increase. Can increase when the company goes for new issue. It goes for an additional public offer, follow public offer. It goes by issuing another 2 lakh shares. Now, how much open interest? 12 lakh. Now in the market, how many shares are traded here? 12 lakh shares are bought and sold. In the right or not? No. Suppose the company buys back. Buyback happens or not? Dividend policy discussion. The company buys back what? 2 lakh shares from 10 lakhs. What is open interest? 8 lakh. After buyback, what happens? Only 8 lakh shares are getting traded. Response is or no? No. So the open interest in shares will get affected when you go for a new issue. When the company goes for a new issue, or when the company goes for what? A buyback. So who can affect the open interest of the company shares? Company only. Yes or no? Now, if at all the 10 lakh shares would increase or decrease, who can do it? Company only, either by increasing number of shares issued or by what? Buying back the number of shares already issued. So the company only will create the demand for what? The company's shares in the market by increasing the open interest or decreasing, or allow it to float at what? 10 lakhs. Ennappa right anna? And they can even go for stock splits or what? Consolidation to make it more, larger base or one smaller base. All this the company only will be able to do it, not the investors. This is how open interest is created in a stock market. Open interest means something that is open for us to buy and sell. Something is open for us to what? Buy and sell is called as open interest, and will buy and sell in the secondary market. Can I proceed? Now, so how the contract is first created? In which market? Primary market. Who creates the contract? Company. And then it is done in what? Secondary market. People want buy and sell. In secondary market, is open interest affected or unaffected? Unaffected. Any person can buy and sell. The shareholding pattern may change, but the number of shares going to remain what? Same only. And the open interest, if at all, is going to get affected once again, it will be done only by what? Company, by a follow-up offer, or by also what? Reducing it through buyback, etc. Some examples I gave. Response is or no. This is the concept of open interest in case of what? A share market. Everybody, are you understanding it? Now, let's come to the futures market. Okay. See, in futures market, company is not at all involved. What is not involved? Company is not at all involved. Okay. Now, which company can be going into futures market? Rules are all that. Okay. Not all companies. Top 500 companies only, they can enter into what? Futures market. That too, they should satisfy some eligibility criteria regarding the volume of trading, etc. But suppose a company is eligible for what? Futures market. So exchange is allowing you to trade in the futures of the company share. Are you following what I am saying? Now, in this case, understand that futures is not issuing shares. Is not what? Issuing shares. It is trading on a share on a forward price. Now, so 10 lakh shares of A Limited is there. How many shares here? 10 lakh shares of what? A Limited is there. In which market? Cash market. Or what? In the secondary market. In my son, no. Now, this is a stock market, right or not? Now, on this 10 lakh shares, I can even create futures contract. What? 1 crore shares. Are you following what I am saying? That is, not that when there is 10 lakh shares, there can be contract only for what? 10 lakh shares. 10 lakh shares may be the share market open interest, okay, but I can create contracts even for 1 crore shares or even for what? 10 crore shares on this 10 lakh share base, because future contract need not be settled through delivery. What they want is only the share price for this 10 lakh shares. I don't want this 10 lakh shares. Are you following what I am saying? The question, what I am saying? Did you understand or not? Now, see, if delivery is compulsory, then I have to buy the share and what? Deliver. In that case, what is available only can be what? Traded. Yes or no? Now, the share, TCS share, price only taken as a base on which I trade on what? Forward, where it is not going to be on what? Delivery. So 10 crore shares also, that means there's going to be a 10 crore buy and what? 10 crore sell. They're going to only book profit and loss and transfer accounts, say amount from what? One account to another account. So don't think that how many shares of TCS is there in the share market, so many contracts of futures only should be traded. No need to think that way. Everybody, are you following what I'm saying? It can be anything. Everybody following point number 1. Now, very simple. Now, today, suppose they announced that TCS April futures starts. Like how we announced batch starting. Batch starts on May 23rd. So, batch starts on what? November 23rd. Every time we start the batch or not, student comes on. Like that. They make an announcement. So, April, say what the future start on some day. Okay, because today is what? March 6th. Or someday they announce that April futures contract what start. Then onwards, from today onwards, people can start what creating contracts on this April futures. Enna paraidana? Now, that means this is going to mature on what? For example, 26th April, it is going to mature. Can I go or not? Now, what happens is, today, the contract is opened or not. In the exchange, the contract is what? Opened. And people start what? Entering into this contract. Okay, now, today, for example, 3% comes and enter into the contract. Okay, X is the buyer and Y is the seller. Z is the buyer, A is the seller. M is the buyer, M is the buyer, and then N is the seller. He enters into 100 contracts. He enters into what? 200. And how many contracts here? 300. Example. Can I put or not? Now, very simple. Yeah. See, contract will happen only when both of them matches. Marriage cannot happen without matching. Yes or no? No. Can't happen when both the parties match. The price is what? Matched. Okay. Contract has happened. Today in the stock exchange, how many contracts? 600 contracts of the futures has been created. Now, between the parties X and Y, Z and A, M and what? N. This is a buyer, this is what? A seller. In between, somebody is being a Shakshi. Who is the Shakshi here? Stock exchange. He is going to be the witness for all this contract. He is going to be the counterparty for what? Every contract. No problem. Margin amount will be what? Collected. Amounts will be credited. Respond yes or no? No. They may enter into what? Different prices. Enter into what? Different prices. For example, this contract is created on 10 a.m. At what time here? 10 a.m. Say it is 2,200 rupees. Suppose it comes at what? 11 a.m. So it is traded at what? 2,100. It may change like share price or not. Now, this is at what? 3 o'clock. Okay, 3 p.m. Correct? 3. Always have confusion like this. 3 p.m. So it is 2,300. Now, that's how. When every contract is created, the exchange says this is the last traded price. We always see the price in the screen or not. What the price is? Suppose they say price is 2,212.1. This second you are seeing, two parties are traded for this amount of rupees here 2,220. Next time another second it jumps to what? 2,100 means what? Another party is for how much rupees here 2,100. The price you see in the stock market screen is the price of the last traded transaction. Everybody follow what I am saying? Did you understand next once again? Are you follow what I am saying? Now, you see in a stock market. Now, if you go into, now it is not open. Okay. Suppose at 12 o'clock, you just enter into the screen and then see, you see always a price going up, coming down, going up, coming down. Autometer will never come down. Okay. So, why it is going up, coming down? Very simple. Yeah. Every second, some person has what? Bought and sold at that price. So, the price what? Increases and decreases. Yes or no? This is the latest traded price. Since it is electronic, they update what? Immediately. Everybody follow what I am saying? Now, like this, a transaction has taken place. Just to visualize, I am saying all this. Can I say? Now, for me, only one thing. Yeah. Now, 600 contracts are created. How many contracts are created? 600 contracts are created for this particular April TCS futures. How many contracts are? 600 contracts. Who created? Company or investors? Now, what we can do? We too can go and create a contract. We too can go and create what? A contract. So, you too can create what? Contract and so on. So, anybody enters, if you can find a counterparty, they create what? A new contract. Yes or no? Like the daily contracts are created. Now, see, what happens is, X with Y, Z with A, M with what? N. I created a contract today. Yes or no? Tomorrow, the market opens once again. Okay. Now, I'll just say like this. One transaction takes place where X wants to come out. X wants to what? Come out. Okay. And A also wants to what? Come out. Correct? Now, one buyer wants to come out. One seller also wants to what? Come out. Their price also matching. They will enter into a contract or not? No. They don't know, but he gives a sell order. He gives what? A buy order. X becomes a seller. Y becomes what? Buyer. Means what happens here? Their contract is closed. The open interest decreases. No. Because X, who is a buyer, is now giving what order? Sell order. and A is a seller, gives what? A buy order. It need not be for the same contract. So X don't want to have 100 contracts, want to dilute what? 50. He also wants to dilute what? 50 contracts. What happens is, he gives a close by giving what? A counter sell, and A closes by giving what? Counter buy, and the exchange matches what? X and A, because the prices are what? Matching. If this happens, what happens is, the outstanding contracts from 600 becomes what? 550, because two existing parties have diluted their position and went out. Respond, yes or no? Now, this is situation number 1. In that case, what happens? Open interest decreases. Now, another situation. See, X wants to come out. X wants to what? Come out. By giving how many contracts? 50 contracts. He wants to come out by selling what? 50 contracts. Okay. But the buyer of the 50 contract is not Z, A, M, N or Y. The buyer is going to want some other new party. Some other want a new party. Say he is Mr. F is what? Mr. F. Okay. So X gives a counter sell, and Mr. F becomes what? A counter buy. Mr. X becomes what? A buyer. In that case, is going to be selling between what? X and buying of what? F. In that case, tell me, will open interest change or will not change? Will not change. It's like a secondary market. So no, one party passes on his buy order to what? Another party by selling it. That's all. So no. How you sell a share to another person, the number of shares will not reduce. Yes or not? Like that, what I do is, I am a buy futures portion. I just give a counter sell to a new party. Means the open interest remains what? Same, will not change. Are you following? Yeah. Should I repeat? Can I proceed? Those want to repeat, raise your hand. Should I repeat? Okay, I'll repeat once again. Rumba simple. First, what happened today? Did you understand? Yes or no? No. Rumba simple. I'll start from the beginning. Once you understand, very simple. Today, announcement made. TCS April Futures Open. What is open here? TCS April Futures Open. They created a platform. That's all. The April Futures is what? Open. Okay. Immediately, what happens here? Three couples jump into the market. Couples, na here investors I am saying. Okay. Buyer and seller. Okay. So three couples enter into the market. Please. Shh. X and Y, Z and A, M and what? N. They enter for how many contracts? 100 contracts at an agreed price, 200 an agreed price, then what? Agreed price. For example, 2,200 is what they traded. What is the meaning of that? Yeah. X has agreed to buy TCS shares on 26th April at how much rupees? 2,200. For how many contracts? 100 contracts. A contract may have 250 shares, that is 2,500 shares. Or 25,000 shares, etc. Are you following what I am saying? Like that, X and Y, Z and A, M and N, three transactions take place today in the stock exchange. Example, how many transactions there? 3 transactions. In which how many new contracts are created? 600 contracts are now with the exchange. Yes or no? No. The exchange is a counterparty for 600 this side and 600 that side. So there's a 600 contracts that is having an open interest in what? Market. Up to this, are you following what I am saying? Now tell me, at the end of today, who are all the buyers of TCS shares? X, Z, M. Yes, X has agreed to buy at 2,200. Z at what? 2,100. M at what? 2,300. On which day? 26th April. Yes or no? Like that. For all the counter sellers are what? Y, A, and then what? N. Yes or no? And they also given you the quantity investor willing to what? Buy and sell. This is futures contract creation. Innappa right anna? Now, next. Today over. Tomorrow the market opens. My question is, should these parties be in the market till April 26th? No. Not at all required. I said that once you enter the contract, don't think that the contract cannot be what? Come out. They can come out anytime you want. If you can find a corresponding party, that's all. You just find a corresponding party, you can just what? Come out. Are you following what I am saying? In that case, now, X feels tomorrow that he does not want to have 100 contracts. He feels too many. Want only how many contracts? Yeah, 50 contracts. He want to dilute his position by how many contracts? Yeah, 50 contracts. Yes or no? So he gives what order? Sell order with the exchange. I'll just give an example. I'll just write it here. So X has given what order? Sell order. Immediately executed? No. The exchange will try to match with one, some other buy. If this is done, then the contract will be crystallized. Yes or no? X has given what? Sell order. Yes or no? How many contracts? 50 contracts. At the same time, let us take A. A is having how many contracts? 200 sell. He wants to have only what? 150. He wants to come out of how many contracts? 50 contracts. At the same time, who gives buy order? A gives buy because he is having a sell. He wants to give what? A counter buy. For how many contracts? 50 contracts. And fortunately, both their prices what? Match. It will match generally. We'll see only price and give the order. Na? Both will what? Match. In that case, there is another contract. How many contracts? 50 contracts. A new contract has come or not? This is a contract between what? X and A. That is tomorrow the first transaction is what? A contract between X and A for some price. Suppose the price is 2,300. What price is 2,300? Very simple. X has taken a buy portion for 2,200. He gives a counter sell for what? 2,300. Books a profit of 100 and goes. Yes or no? No. Like that everybody will be having some number. Everybody follow what I am saying? And they will be settled at the previous settlement price also. Can I proceed on? No. In this case, now I ask you a question. X has sold, A has bought, a new contract created or not? Is my open interest yesterday 600, now it becomes what? 650. True or false? False. Because X is diluting his position, A also what? Diluting his position. The new contract is not for creating a new portion, is for what? Diluting an existing portion. So no, in that case, the open interest increases or decreases. It becomes how many contracts? 550 contracts. Are you following what I am saying? Now, on the same day, Z also wants to come out. Who also wants to come out here? Z also wants to come out of 100 contracts. How many contracts here? 100 contracts. Okay. Z has to come out by giving a counter buy, a counter sell, counter sell. For how many contracts? 100 contracts. Now, for him, the other party who gave a buy order is Mr. F. Is what Mr. F? He gave what order? Buy order. Respond. How many contracts? 100 contracts. This is the first transaction today. This is what? Second transaction. Yes or no? Now tell me, in this case, new contract created or not created? That is, what happens is, one party diluting his position and new party entering into the position. Yes or no? No. In this case, nothing is going to happen. From Z the buyer, we become what? F the buyer. That's all. Okay. Only the contract changes hands. It will not affect the open interest portion. Are you following what I am saying? Yes or no? No. ரொம்ப simple, yeah. See, Z is a seller, na? Okay, he is creating a new seller, liquidating his buy position, liquidating his buy position. Yes or no? No. Next, who is the buyer? F, a new buyer. Yes or no? No. What happens is, as a buyer, I am X, na? I am Z. I am Z as a buyer. I just sell you the contract. I just want to sell you the contract to a new person. Very simple. F will come and sit in place of what? Z, and the contract is continued. Everybody, are you following what I am saying? In that case, one person diluting, a new person what? Coming in means there is something similar to secondary market. What market here? Secondary market. In secondary market, tell me what is going to happen? Will the number of shares of the company increase or decrease or will not change? Will not change. I am having a TCS share. I sell you the share. You buy what? Share. That's because you are buying a TCS share. TCS share will not increase. That's why I am selling. It is not going to what? Decrease, because there is a transferring a hand between one party and another party. Respond is or no. In that case, will the open interest change or will not change? Will not change. No. Let's take the third. Today, Mr. C is a buyer. New contract buyer. And then Mr. D is what? Seller for 200 contracts. How many contracts are? 200 contracts. My question is, C and D, it is taking place or not? C is a older new person. Older new person, new person. D is also what? New person. In that case, what happens? The open interest increases. New contracts are created. No. Understand that three things can happen in a transaction. When a futures contract is entered into, it can be three types of contracts. One is one contract where the two existing parties are diluting their portion. Yes or no? A buyer gives a counter sell, another seller gives what? Counter buy. It is dilution of portion of what? The two existing parties. In such case, when a futures contract arises, it increases open interest, decreases open interest, will not change, decreases the open interest. Yes or no? No. So if it is between two existing parties diluting their position, the open interest gets what? Decrease. Now, it is between one existing party diluting by giving a counter buy or sell, and a new party what? Stepping into his shoes by making what? A buyer or seller. In that case, what happens? The open interest remains unchanged. When it is between two new parties, open interest what? Increases. This because of open interest. Everybody yes or no? So daily basis, open interest may what? Increase as well as what? Decrease. People read open interest very carefully to know whether market is booking profit and running out or market for a share is what? Expanding. Do you understand what I am saying? See, ரொம்ப simple, yeah? When the futures prices keep on increasing, keeping on what? Increasing. What happens is, when lot of futures buyers books profit and then what comes out, what is going to happen is, that means what? The market is showing a trend where the openness starts what? Decreasing. When the openness starts decreasing, two things happens here. People feel that the price is going to what? Further increase. The sellers are also afraid. Buyers also what? Afraid. He wants a restrict loss. He wants to what? Book profit and come on. Everybody following what I am saying. In that case, they understand whether it is a bullish trend or what? Bearish trend by seeing the open interest movement. Everybody follow what I am saying. And one more thing, it is safer to go for a share having lot of open interest. As lot of what? Open interest. Suppose I have open interest of 10 lakh contracts. Now I have vibrant secondary market. Because if you want to come out anytime, what happens is, there's some other person what? Waiting for me to buy or sell. Or you follow what I'm saying? But if I have a small open interest portion, the problem is I have to always find what? A new entrant into the futures market for me to exit. Everybody follow what I'm saying? A big open interest means they are good futures contract having what? Lot of secondary market. Depth is more in the market. Otherwise what? The depth is less. Is what the analysts use to understand the open interest. Everybody follow what I'm saying? More about that we'll be discussing during the contagon backwardation later. Are you following what I am saying? This is the concept of open interest. Now, ரொம்ப simple. இப்போ சொன்னா open interest will increase, decrease, remain same. Now, tell me, what is open interest increasing? Two new parties enter into a futures contract. That becomes a new contract. That becomes what? New contract. Open interest increases. Yes or no? This is something similar to IPO of the company. Company issues IPO, creates new shares or not. Like the new contracts are what? Created due to this. Point number one. Yes or no? That is exchange, some more extra margin account gets opened. Can I proceed? Now, second, one party diluting, new party coming. One party what? Diluting, new party what? Coming. Okay. Then what happens to open interest? No change, because a buyer dilutes by giving what? Counter sell, and the new party giving what? A buy. That means this buyer goes out and some other buyer what? Comes in. No new contracts are what? Created. In the open interest remains what? Same. Something similar to secondary market. Something similar to what? Secondary market. Third is the open interest decreases. Open increase or decrease. Open interest what? Decreases. Where both the parties are old parties diluting the respective portion. A buyer gives a counter sell, a seller gives what? Counter buy. That means what? The contract is getting close or what? Cancel. Then open interest what? Decreases. Everybody yes or no? Daily open interest will increase or what? Will decrease. If watch the futures market closely, in thousands of contracts, sometimes even in what? Lakhs, open interest may decrease as well as what? Decrease. They always disclose at the end of the quotation something called as what? Open interest for each and every contract. Everybody, are you following what I am saying? This is the concept of open interest. Can I proceed further? Now, let us take the next sum and then I'll give you the notes in this regard. Take question number question number 7 is not a problem. There's a future quote given for a gold in CMX, that is Chicago Mercantile Exchange, against dollar. They given you a gold. Please. I given you another sheet also for what? TCS shares. Only learning how to read the quotation. I'll come back to that later. Now I'm going to do question number 8. Question number 8. Let's do this sum together quickly. Stop talking, please. Now, in a futures market, following transaction took place. Day 1, A long, B short 8 contracts, X long, Y short 6 contracts. Day 2, A short, Y long 2 contracts, X short, C long 6 contracts. Calculate the open interest on day 1 and then day 2. That's a question. Everybody following what I am saying? That's a small problem to understand how the open interest gets created or diluted. Can you start doing it together or not? Now, write down question number 5. Give the heading concept of question number A. Question number A. Concept of open interest. Please. Shh. Can we start them? Have the following columns. Day, transaction, day transaction, open interest, plus, minus, and then balance. Plus, minus, and balance. Can I start or not? Now, you should tell me first day 1. For the first transaction, today, how many transactions took place in the futures market? 2 transactions. First transaction between whom and whom? A is buy, and B is what? A is buy, B is what? Sell. It's a futures contract between A and B. A buyer, B is what? Seller. How many contracts? How many contracts here? Today the first day opened, okay, contract. So it is plus or minus or plus. 8 new contract came. I just put in what? Plus. Open interest created for 8 contracts. That's all. Any more transaction today? Yes. What a transaction? X is a buyer. Y is a seller. How many contracts? Another new 6 contract is created. New 6 contracts are created. So, any more transaction today? No. Today, tell me what is the open interest? 14 contracts. C means what? Contract. 14 contracts is open interest on day 1. Ennappa purinjudha? Now, next. Day 2. Tell me what is the transaction? First transaction, day 2, tell me. Who is the buyer? Correct as well. That is Esha. Who is the buyer? Y is the buyer. Y is the buyer. And who is the seller? A is the seller. I want to tell me how many contracts? Okay, now understand that, please. 2 contracts has been created. Okay, now this creation is dilution or new creation or no change. Because A is what? Diluting his position. Y is what? Diluting his position. These two wants to come out of the market. Both parties has to come out. Buyer also wants to come out. Seller also wants to come out. In the contract gets what? Increase or decrease or decrease. Tell me what is the open interest position? 2. It is minus. It is what? 2 minus. Yes or no? That is two contracts above. 2 contracts are going out of the futures exchange because A, the buyer, wants to come out of the contract, and Y, the seller, also what? Come out of the contract. They join together, come out. They are reducing what? 2 open interest. Everybody, are you understanding it or not? Now, Purunjida? Please, can I proceed? Now, another contract. Correct or who is buyer? C is the buyer. X is the seller. Please, one by one. Let us discuss. Now, C is the buyer. Tell me, C is already there a new party. New party. Now, X is what? Already there. He is holding what? Yeah, buying portion. He wants to what? Dilute by giving a selling portion. That means, very simple. X as a buyer comes out. In his place what? C comes and sits in. Will the contract reduce or no? No change in contract. Contract changes hands. That's all. Are you following what I'm saying? In the first case, contract is gone because 2 parties are going out. It gets diluted. Yes or no? Second case what? Contract changes hands. Now, how many contracts? How many contracts here? 6 contracts. Will it change or will not change? Will not change. This alone a bracket, right? How many contracts here? 6 contracts. For me to have a track. How many contracts? 6 contracts. Open interest will change or will not change? Will not change. Neither increase nor decrease. Respond yes or no? No. At the end of the day 2, it is 14 contract minus what? 2. How many contracts here? 12 contracts are there in the future section. How many contracts here? 12 contracts are there in the future section. That is, there are 12 buyers, 12 sellers. That is, the stock exchange is a counterparty to how many contracts? 24 contracts. There's a 12 buy contract for which they're going to be what? Sellers. And 12 sell contract for they're going to be what? Buyers. Don't think different prices. It is not so because they always mark to market. Understand one thing, at the end of every day, the price of every contract will be what? Same only because they're booking profit and loss, sending them down. Yes or no, what I'm saying? So always, the buyer and seller for the 12 contracts here, 12 contracts there, all with what? The same price. All with what? The same price because they always mark to market each and every contract. So they need not worry about whether 2 to 2 matching 2 to 6. Not so. They have 12 this side, 12 that side. All that will be having what? The same buying price or the same selling price because every day it becomes a settlement price. Are you follow what I'm saying? What happens? So this is going to be the issue. Now, can I see what is the position inside the stock exchange or not? Now. So up to this I will copy it. I think you want to do along with me or not? Now, 12 contracts are there. Okay, now, please tell me the names of the persons in the stock market in the 2 days. Tell me names of persons here. A, B, X, Y. That's all, no? A, B, X, Y and then C. They can be either having a buy position or what? Sell position. One by one tell me. First, A, and that is, let us take A first. Okay. A on day 1 had what? 8 contracts buy. How many buy? 8 contracts buy. Okay. Is A having any sell? Yes. He sold how many contracts here? 2 contracts. His net position is what? 6 contract. Is going to be what? B means buy. I write 6 contract what? Buy. Everybody yes or no? At the end of day 2, A is having what? 6 buy contracts. Now, come to X. X is having how much? That is, day 1 is what? 6 contract. X is having, B. B. What is B is having what? 8 contracts. Sell. Is having 8 contracts. Sell. And B coming out anywhere? No. So B position is, how many contracts here? 8 contracts. Is going to be what contract here? Sell contract. Ennappa, right or not? Now. Come to next part is what? X. X is first having what? 6 contracts buy. Is how many contracts buy here? 6 contracts buy. And then X is having also what? 6 contracts sell. Is X in the market or not? No. He has gone out of the market. Yes or no? No. Next is what? Y. Tell me, Y is having only how many contracts? 6 contracts sell. Okay. Now Y is having what? 2 contracts buy. He is having what? 4 contracts sell. He is having 4 contracts sell. Yes or no? Now, my last party is what? C. C is having what? 6 contracts buy. How many contracts sell? Nil. What is that here? 6 contracts buy. Yes or no? Now, if you see the margin account, the exchange is having 6 contract of A and 6 contract of what? C. As a buyer, for the exchange is counter seller. Similarly, for the exchange, B 8 contract and Y is what? 4 contract. He is having what? Sell. For exchange is what? Counter buyer. Yes or no? What happens? He collects money from those 12 contracts and pays money to what? Other 12 contracts, which is making a profit or loss. Everybody follow what I am saying? So the open interest, how many contracts here? 12 contracts are open interest. When the exchange is standing in between us what? The counterparty for either of the 12. Everybody follow what I am saying? Now, you need not worry. This 6 is for Y or C or that is, this 6 is for this. You know say, sir, this 6, 8 plus 6 is for what? A. And balance 2 is for what? Y. No need to do all those things because X is not a counterparty to A or Y is not a counterparty to what? C. Nobody is counterparty to another person. Is everybody counterparty to what? Exchange. For the exchange, the total contracts on left hand side, right hand side tallies, that is enough, the clearing house will settle. Are you following what I am saying? That's how the futures market works. What the open interest here? 12 contracts, the open interest at the end of the day 2. Everybody following. Now are you able to visualize how the market works or not? This is how the open interests are created and the exchanges are settled. Now you should understand the importance of mark to market. If you don't have a mark to market, different persons on different days will be having what? Different prices here. It will be difficult for the exchange to want to match them. Are you following what I am saying? So then and there if you put a book of profit and loss, and a person wants to come out, he comes out on what? The current price and not the old price. Everybody follow what I am saying? So this is what we call as the open interest portion and how the exchange trades in the futures contract. Are you having the clarity here? Those who have understood, raise your hand. Full clarity now. So let's this you have copied. You copy this, write down. This you have copied, huh? The open interest at the end of day 2, right? The open interest at the end of day 2 is how many contracts? 12 contracts. The open interest at the end of day 2 is 12 contracts, which can be understood in more detail as follows. Which can be understood in more detail as follows. Which can be understood in more detail as follows. And just copy this. A, B, X, Y, C. You finish copying, huh?